The stock market has rallied by more than 20% since its low in mid-March. In fact, it has risen by 29% as of Tuesday, 21st of April, which is when I'm filming this video. So, should you invest in the stock market crash now or wait? Let's take a look at some of the mainstream media and what they are currently saying right now. Right, so this is an article by CNBC, right? So this article mentions these strategists who warn investors that there was nowhere to run now sees opportunities as earnings seasons begin. This strategist, believe that now is the right time to invest in the stock market. And then let's take a look at another article. So this article is by CNN, right? So this article mentioned that the stock market is acting like a rapid recovery. It's a slam dunk. So a slam dunk is like a sure thing. So he mentioned that it's not, right? So one article mentions that we should invest in the stock market now, while another article mentions that we should not invest in the stock market now. So should we invest in the stock market now or should we wait? To understand this question, I believe we need to take a look at this concept, which I'm going to share with you in a couple of moments. And I believe that this concept will help us make better and more informed decisions when we are investing in the stock market, be it now or in the future, right? So let's take a look at this concept. So this concept is the risk to reward ratio, right? So basically what a risk to reward ratio is that the amount of risk that you're risking in the stock market to the potential returns that you can generate in the stock market. So what is your risk in the stock market? So your risk in the stock market is the potential amount of capital that you can lose when you place in the stock market. So that's the risk. So what is the reward? The reward is the potential returns that you can generate from investing in the stock, right? So when we invest or when we trade in the stock market, one of the first things that I always look at is the risk to reward ratio. And I only want to enter my positions in the stock market or in the stock when the risk to reward ratio is good. So at first glance, if I see that the risk to reward ratio is not good, then I would not invest in the stock and enter my position in the stock market at that time. So some of you might be asking me, so Linus, what is a good risk to reward ratio, right? A good risk to reward ratio is subjective, but for me, a good risk to reward ratio is 1 to 1.5 or more. So what this means is the downside is $1 and the upside for me is $1.50 or more, right? So for example, if I invest in a stock, if I'm looking to invest in a stock, I want to make sure that for every dollar that I can potentially lose, I potentially can make $1.50 or more. And if you can achieve this risk to reward ratio of $1 to $1.50 or more, guess what? Over time and over a number of trades, you will be profitable in the stock market. So why is this so? Think about it in this way. So for example, when you are investing in the stock market, for every dollar you lose, you make $1.50 or more on average back. So over time, can you see how you'll be profitable in the stock market, right? So that is why when I invest in the stock market, I like to see a risk to reward ratio of 1 is to 1.5. So how do I go about determining the risk to reward ratio in the stock market? Let me walk you through the steps on how I determine the risk to reward ratio when I invest in the stock market, right? And once we understand the risk to reward ratio, then we can answer the question whether we should invest in the stock market crash right now or should we wait, right? So the first thing that we should take a look at is the average percentage decline in the S&P 500, right? So this article mentioned that the S&P 500 on average declines by 32% from peak to trough, right? So the peak to trough means the highest point that the stock market made during that period, and the trough is the lowest point that the stock market reached during that period. So the average percentage peak to trough decline in the S&P 500 is 32% according to this article, right? The next article that we'll take a look at is the history of the S&P 500. The history, specifically the history of the bear market and recessions in the S&P 500 in the past 90 odd years, right? So in this article, I highlighted some of the worst recessions and bear markets in the past 90 years of the history of the S&P 500, right? So you can see that some of the worst recessions and bear markets were during this period, 1937 to 1938, where the S&P 500 declined from peak to trough by 54%. And for this one was 1973 to 1975, the S&P 500 declined by 48%. And then this one from March 2001 to November 2001, the S&P 500 declined from peak to trough by 49%. And then from December 2007 to June 2009, so that is the Great Financial Crisis. But during that Great Financial Recession, you see that the S&P declined from peak to trough by 57%. Right, so these are some of the more severe recession and severe bear markets in the history of the S&P 500 for the past 90 odd years. Now that we know the average percentage decline of the S&P 500 during a bear market and during a recession, and some of the worst recession and bear markets in the S&P 500 history, let's take a look at the stock market right now and see where we are at currently. Right, so this is the price chart for the S&P 500 or the SPY, right? So the high at this point, the high for the year was 339.08, and then that was the peak, right? So the highest point for the S&P 500 during that period is called the peak. So this was the peak, and the lowest point is the trough. So the trough was at this point, right? So how much did the S&P 500 decline from the peak to the trough? So the S&P 500 declined by 35.6%. We know that the average percentage decline in a typical bear market or recession is 32% according to the article, right? So for this 2020 stock market crash, prices declined by 35%. So it declined slightly more than the average. Let's take a look at an example of how we can apply the risk to reward ratio. So if we have invested in the S&P 500 near or close to the bottom, what do you think our risk to reward ratio is, right? So to calculate the risk to reward ratio, we take a look at the past history, right? So we have already seen the history of the S&P 500 in the past 90 odd years. So during the past 90 odd years, what was the greatest decline in the S&P 500 during that period? The greatest decline was during the Great Financial Crisis period, right? Where prices declined by 57% from peak to trough. So right now, at near this bottom for the stock market during 2020, how much more downside do you think that there is if we have invested here? The downside will be 20%, right? Why 20%? Because we know that in the worst case scenario, as history has shown us in the past 90 odd years, prices can decline by 57%. So prices declined 57% during the Great Financial Crisis from peak to trough. So if we have invested here, our potential downside would be roughly another 20%, right? Because 35% plus another 20% will be around close to 57%. Right, so can you see that if we have invested in the S&P 500 during this period near or close to the bottom, our potential downside would be around 20%, right? So that is our downside. Now that we know the downside is 20%, what is the upside when we invest in the S&P 500 near or close to the bottom? To take a conservative estimate, the upside would be the S&P 500 returning back to its high of the year, right? So the high was this period. So it's a very conservative estimate because we agree once this situation is over, the economy will go back to its previous high. Sure, it might take some time, but will you agree that it will eventually reach the high here, back to the high? So a conservative estimate would be the S&P 500 reaching back to its high of the year, which is at 339.08. So that is the potential upside. So if we have invested in the S&P 500 during this period, our potential upside is back to the high of 339.08. So the upside will be also 35.6%. So why is it 35.6%? Because from the high to the low, we declined by 35.6%, right? And if we have invested close to or near the bottom, the upside back to the high would be also around 35%, right? So our upside is 35% and our downside is 20%. So if we have invested in the S&P 500 near or close to the bottom, do you think our risk to reward ratio is good? It is a good risk to reward ratio, right? Because we are achieving 1 to 1.5 or more, right? So at this point here, if you have asked me to whether I will invest in the S&P 500, it will be a very good point to invest, right? Because the risk to reward ratio is good. But let's say right now we are around here. So right now I'm filming this video on Tuesday, which is the 21st of April, right? So right now we are at this point currently. So do you think the risk to reward ratio is good? So right now, I do not believe the risk to reward ratio is good, right? So this is the first reason why I'm not investing in the stock market right now, because the risk to reward ratio is not good. So let me explain a bit more of why the risk to reward ratio is not good, right? So if we have invested right here, what do you think our potential downside will be in a worst case scenario? So in a worst case scenario, prices will decline all the way below here, right? Because we know that in the past 90 odd years in the S&P 500 history, the worst decline was 57%, right? So 57% will be around this point. In the worst case scenario, our potential downside will be from here to here. So right now, currently, prices have already clawed back more than 50% of the decline already, right? So since it has clawed back more than 50% of its decline, what do you think the potential downside is? So the potential downside back to the previous low of 2020 will be 17%, right? Or 17 or 18% around there. So it will decline by another 17 to 18%. But in a worst case scenario, it will decline. After the 17 to 18% decline, it can decline by another 20% or more, right? So our potential downside will be around 38%, right? So that's our potential downside. So what's our potential upside if we have invested in the stock market right now? So again, taking a conservative estimate, our potential upside would be back to the highs, right? So back to the highs, how much more can we gain? We will have gained around 17 or 18% more, right? So if we take the upside, which is around 17 to 18%, and our downside is around 38%, do you think the risk to reward ratio is good right now? No, right? The risk to reward ratio is not good right now. So that is the first reason why I'm not investing in the stock market right now. But that being said, my situation might be different from you guys, right? For example, I have already invested most of my positions in the companies that I want to invest in already, right? Please check out my video over here where I share with you the top 5 stocks that I'm placing on my watch list and have already invested in, right? Those are some of the companies that I already invested and enter my positions in, right? Since I have already invested some of my positions in the companies that I want to invest in, I'm not so pressed up to invest even more, right? So sure, if prices continue to decline, I will invest even and add even more positions in those companies. But for you guys, it might be different. So for some of you, you might not have entered the stock market. So it might be a different scenario for you. But for me, I'm not investing in the stock market right now because first reason is because I have already invested most of my positions in the companies that I want to invest in already, right? And the second reason is because right now, I believe that the risk to reward ratio is not good enough for me to justify buying and investing in stocks right now. So that's the first and second reason, right? So the third reason I want to share with you guys why I'm not investing in the stock market right now is because I believe that the stock market is overbought. So right now, prices have been increasing for the past couple of weeks and past couple of days, right? So I want to show you why I believe that the stock market is currently overbought. Let me show you a graphical illustration of how stock prices move when they move up, right? So they do not, if you have been watching my past videos, you have known that prices do not move up in a straight line. So how prices tend to move up is it tends to follow this motion, right? It follows this wave motion. So right now, where do I believe we are at currently, right? So when prices increase, if it will increase for a while, then it will decrease, then it will increase, and it decrease, increase, and decrease, and so on and so forth, right? So right now, I believe we are close to or near the top here, right? So we are near or close to the top here with at a red circle, right? So at this circle, prices are overbought. So when prices are overbought, prices tend to fall back down for a while. So right now, I believe that prices are a bit overbought. So when prices are overbought, they are like in this illustration, they are near the top of the wave. So when they are near the top of the wave, what do you think will happen next? Prices are likely to fall, right? Right now, if you invest in the stock market, what is likely to happen? Prices are likely to decline in the near future, right? So that is the second reason why I am not investing in the stock market crash right now, because right now I believe that the stock market is a bit overbought, right? So there are different technical indicators that I look at to determine overbought conditions. So one of the technical indicators that I look at is the Bollinger Band. You can check out what Bollinger Bands in this video over here, where I explain to you how to use Bollinger Bands and how to determine whether stocks and the stock market is overbought or oversold, and what to do when the stock market is overbought and what to do when the stock market is oversold. So right now, I believe that the stock market is overbought. So when the stock market is overbought, chances are prices are likely to decline in the future. So if prices are likely to decline in the near future, would you want to invest in the stock market right now? No, right? So these are the reasons why I'm not investing in the stock market crash right now, right? So the first reason is because I already invested most of my positions in the companies and stocks that I want to invest in already, right? So I have done most of my shopping already. So that's the first reason. The second reason is because right now I believe that the risk to reward ratio is not good enough to justify me buying more positions right now. So that's the second reason. So the third reason is I believe that the stock market is a bit overbought right now. So when it's overbought, prices tend to decline in the near future, right? So if prices are likely to decline in the near future, then it's not wise to invest in the stock market right now, right? Because if prices are likely to decline in the near future, why not wait a bit more? Then after prices have declined a bit, then you invest in the stock market, right? So those are the reasons why I'm not investing in the stock market crash now, right? So I understand that my situation and your situation might be different. And that is why I want to mention that do not take this as financial advice, because I'm not a financial advisor or anything like that, right? So make sure you do your own due diligence and make sure you do your own research before investing in the stock market. If you guys have liked and learned something from this video, make sure you smash that like button because it really helps with the algorithm and will help this channel grow. If you want to watch more videos such as this, make sure you subscribe to my channel because every week I release one new video about investing, trading, and the stock market. So I'll see you in those videos to your financial success.